started here as an undergrad. It was an M&T program, so chemical engineer as well as a finance student in Wharton. When I was actually in the M&T program, I thought I was going to graduate and going to start a great career in chemical engineering, and somehow this finance degree would be helpful in calculating how much a reactor costs or something. It ended up being the opposite. I went into banking, but the engineering degree, the quantitative background obviously helped me with my finance career. But I knew very early on that ultimately the agent work that you do as a banker wasn't satisfying. It wasn't intellectually challenging enough, and I knew that I was eventually going to get myself back into the side of the business where you had a principal role, where you were getting your hands dirty, maybe not literally, but hopefully at least operationally. So over time, what I decided to do was to refine my skill set by moving out of just the agent role, where you're basically in a deal, make sure it gets closed, and you move on to the next, by getting myself back into the chemical industry, getting involved in the operating of chemical businesses, and most specifically actually helping them grow their businesses through strategic transactions, acquisitions, joint ventures, alliances. And I spent a number of years doing this for both private equity-owned businesses as well as public companies, before eventually stumbling upon Arsenal, which is a specialist in the chemical space, making investments in middle-market chemical businesses. We're an $800 million fund. We specialize, again, in the middle market, which is a very broad term that is defined by, or set by whoever actually thinks that they're in the middle market. It could be as small as $10 million or as big as $1 billion. We view it as $100 to $300 million type of businesses, but more importantly, in the chemical space, there are businesses that float under the radar for large companies. And what the background I had here at Penn, particularly on the engineering side, coupled with obviously my great education in school, as well as my time both in the finance side of the world as well as the operating side, was how to work with operating companies, how to help improve them both from the inside and the outside, which is crucial in the private equity world. I mean, in the buyout world, people talk about leverage you get and selling at a great multiple and cutting a great deal, but ultimately, particularly in today's market, there is no more arbitrage. You can't fool a seller into selling a great business at a discount price. And certainly today, you can't get as much leverage as you did before that would help drive or boost returns. So the best funds, the ones that will survive, and hopefully that's what we do at my shop, is actually try to genuinely add value, create value, sell a better business, a better positioned business, a more secure business at the end of your whole period than you actually got. Eventually moving that business on to the rightful owner, but in the meantime, again, creating real value, true value with that business. And again, the operating side of the experience as well as the finance side of the business, I think I learned here as well as I learned elsewhere, helped me to do that. And that's basically what I'm involved in. So, did I do that in 7 minutes? Yes. Pretty close. So I don't even need to see the slide.
Sure.
It's all yours.
Okay. I'm going to stand up. I've had here for 25 years. I can't talk sitting down in this room. I'm Michael Aronson. I went here as an undergraduate, graduated in '78, started my first software company while I was an undergrad here. Remember, this was 1977, with one of my professors who was absolutely brilliant. Company was successful. He was killed tragically. We sold the company. It was a pretty good exit for a 22-year-old in those days. Came back here to teach. Started another company to do a subset of what the first company did. Hired lots of my students over on Market Street. We grew that company to about $25 million in revenues, and we sold it. Along the way, while I was doing that over about a 15-year period, we started a couple other companies with really smart students of mine. Both of them were in the M&T burger that you were in. We sold those companies. Both of them fairly quickly, one for a very good return and one for a very nice return. After we sold our largest company and after I was sort of done teaching, people said to me, "You're really good and passionate about starting companies out of school. Why don't you do it on a more formal basis?" So we decided we were going to raise a fund. That's Tech Ventures. We're headquartered over on Market Street. We're an early stage investor. We invest in technology companies. And they also have to have some connection to Penn. So we have working companies and engineering companies and working and engineering companies and some things out of the medical system. Tech is often the first institutional investors. So we're based here in Philadelphia. We have about $40 million under management. We've invested in 25 companies over the years. We've had some very nice exits out of the portfolio. As we were chatting earlier, we invested in a money transfer business that was started by Wharton MBAs in 1999. They said they were going to be an overnight success. It took them 9 years. They did not put Western Union out of business, but they did build a better mousetrap, having to be Post-Patriot Act compliant, and they also got a couple of key customers, and Citi bought them for about 10 times revenues. We weren't investing in them for all of that period. We came in a little bit later. We have a lot of other interesting things in our portfolio. Okay, so we're a broad-based technology fund. There does need to be technology. We invest in information technology companies. So we had that company that we mentioned, PayQuick. A company here in town that's getting a lot of buzz lately is a company, Ticketly. A lot of the Wharton events use it as their online ticketing platform. They compete with a company called Eventbrite. It's out of the West Coast. It's Sequoia-backed. We have a monster company in our portfolio, started by a Wharton MBA student and a UPenn undergrad, the two founders. That's diapers.com. They were the front page of Businessweek last week. They came into our office. They were doing about $200,000 a month in revenues. They'll do $320 million in revenues this year. Hopefully that might be the only company in our portfolio that ever goes public through an IPO process. Another company started by an undergraduate at Wharton, Nathaniel Stevens, Yodel, started out as NatPal. He would have been class of 2005, but he decided to start a company, build it up to about $65 million in revenues this year. But he did come back last year to finish his undergraduate degree. Had a very good time on campus. He's actually still here, at least through December. He's working on what his next company might be. But that company was involved in the Venture Initiation Program, which is a great program. I'm sure a lot of you have chatted with it, thought about that. And they moved from the Venture Initiation Program directly into our incubator. Our office is over in Market Street very late one night. Another company that we have locally is the Neat Company. They're over on Market Street. That was founded by a former Wharton accounting professor. They have scanners and software to read business cards and receipts and documents. That company will do about $35 million in revenue as a startup, founded by a Wharton professor and by Harris Romanoff, who is an engineering alum. He's actually the honoree Friday for the Young Alumni Award. Great person. And I know he's done a lot with the engineering school. We also invest in medical technology. We started out saying we're going to do IT and e-commerce because that was my background. We realized that we couldn't ignore what was happening on Penn's campus in the medical technology area. So the first investment we made was in a company called Gentis. This is an official Penn company. Penn owns equity in the company. Started by a bioengineering professor, Paul Deshane, who had a successful public company. They are in their human trials right now. The product they're going to market with is injectable material for the spine, for damaged discs. In the spine, and hopefully we can sell a company probably based off that human data. Another interesting company is STR, soft tissue regeneration. How many of you had ACL replacements? You guys had ACL replacements? Okay. There's a couple different ways. Well, this is a new way to do it. Using all your own cells, which will regenerate inside the body. It's in the regenerative medicine area. We're working off a scaffold. It's a very exciting company. Top orthopedic surgeon probably in the world, Dr. Jimmy Andrews, is working with us on that. We also have another very successful merchant circle, which is similar to Yodel, actually, and helps local merchants get found online. We have one offline company here that's out of Penn, started by an undergrad, Adnan Aziz. First Flavor came out of the Weiss Tech House, and they essentially use Lister Mint strips type technology, and they do strips for sampling of products. And they actually have a lot of traction right now in the alcoholic beverage marketplace. Usually I give up the strips. You don't have that. So we get our deals from the university, from faculty members, from students. If you have a friend or you're starting a company, it's going to be the next great company out of Penn. And there have been a lot of really good ones. Please bring it to us. Always happy to chat. Talk about my background. Let's talk just a little bit about the other members of the team. Boris Callender has been my partner for 20 plus years since he was here at Wharton, even a little bit beyond that. He actually claims to be one of the first MBA grads at Wharton who were born in Russia that weren't KGB. Now it's really commonplace, but at the time he did it wasn't. Brett and Jordan are both undergrad alums of Wharton. Brett got a job right out of undergrad, which is very hard to do, working for a venture fund over in New Jersey. Had interned with them, and then joined us for the second Mentor Tech Fund. And we hired Jordan a couple years ago, directly out of the undergrad program, but he had interned for 2 summers, I think, with a healthcare-oriented private equity fund down in Nashville. But that's Mentor Tech.
All right, thank you. So now we'll open up to questions for our 3 speakers, any of them, or all. So, questions? Yeah.
I have a question for you, Mr. Giorgio. I just want to know how long you hold to businesses in your investment process.
Well, we have, by our fund mandate, we can actually keep businesses as long as 10 or 14 years. But generally, our average has been between 5 and 7 years. Quite frankly, it's until we feel that it's reached a certain critical mass such that it's going to be an appealing business for strategic acquirer. So we sold businesses in as little as 2 years. But, in contrary to the popular belief about private equity in terms of flipping businesses, we're willing to hold them as long as we need to in order to make sure that they're ready for prime time.
Anthony, you actually sit on boards of some of those businesses.
I sit on the boards of all the businesses that we acquire.
Can you tell us about that?
Yeah, as I was mentioning before, it's more than just transactional. That's part of what I spend my time with, is the transactional. We find the businesses, the structuring the transaction, negotiating transactions, financing the deals, selling the businesses. But more importantly, again, as I said, in today's economy, you just can't rely upon good leverage and buying right or selling right in the direct return. You actually have to add real value to the businesses. So I spent a lot of time with the portfolio businesses. Everybody on the chemical team at Arsenal are all chemical engineers out of the chemical industry. We've had experience working in factories or working in chemical businesses. So we work very closely with management to help really drive improvement and change, either operationally or commercially or strategically. So most private equity groups usually they'll all have somebody from the investment committee sitting on the board. But we get more involved in being very active board members and sometimes taking management roles in these businesses.
Michael, Paul, do you want to talk about that? Do you actively manage the portfolio companies you work with?
We do.